Welcome to Pique Your Interest, your go-to podcast for all things mortgage and real estate. Hosted by Tanner Greenwald and Tim Malaskis. We bring you expert insights to help you buy, sell, and invest with confidence. Let's dive in.
Welcome back to the Pique Your Interest podcast, the podcast that seeks to demystify all things mortgage and real estate related. We are your hosts. I'm Tim Malaskis.
I'm Tanner Greenwald.
And we are here today to talk about closing costs. I would say one of the most asked questions, one of the most frequently asked questions that we get in this industry is, what are closing costs? What does it consist of? Do I have to pay them? Can I roll them into my loan? Things along those lines. So I think, today we just want to talk about what some of the typical closing costs are, what are the reasoning behind some of them, and, in general, what it is that you're looking at when you're looking at, a loan estimate or a closing disclosure. What are the costs that are listed on there? So the first thing we'll talk about is lender fees. First home is a certain set of fees that we charge for the service that we perform. Things like processing fee or an underwriting fee, and those fees are exactly what it sounds like. They pay for a processor, they pay for an underwriter. There are a lot of hands that touch a mortgage file, from processing, underwriting, closing, compliance, various verifications, employment, verification of rent, verification of mortgage. There's a lot of people that are involved in the mortgage side of things, and so it makes sense that there should be fees associated with that. So you'll see things like processing, underwriting, application. I guess a lot of people would consider that a junk fee in air quotes, but it really does have a purpose, and it really does allow lenders to employ these people that help on the back end, sort of behind the scenes, pay for those people that perform those services.
Yeah. It's funny that we call them junk fees. Well, some things junk fees, because I feel like a lot of fees they have their own importance.
Yeah, definitely.
So the appraisals. So when you purchase a home, you have to have somebody, a licensed appraiser, go out and value the property for you. That does inquire a cost. The costs can vary. Certain mortgage companies obviously have their own fees and whatnot. We have our fee. It gets paid by the borrower before the loan settles, but it is going to be considered a closing cost for the borrower. Again, the borrower is paying it before the loan does close. But that is an additional fee, and it's just to have the appraiser go out, value the property, get back to us, and that's what you're paying for, basically.
Yeah.
In the appraisal.
Yeah, and we need an appraisal as lenders. Obviously, we need to know that the property is worth what you're paying for it, because if we're fronting the money for this, we need to make sure that there's value in what you are purchasing. So it's a level of protection for both us and the consumer to make sure that they're covered, to make sure that the value is actually there. You're getting what you pay for.
Yeah.
Another important cost is title insurance. So title insurance protects whoever purchases it from any kind of defects in the lien. So, essentially when you go to buy a house, there's an owner, right? There's a seller that owns the property currently. You want to make sure that the person that's selling the house to you is actually the owner of the property, that any kind of liens that might have been on the property prior to you taking ownership are satisfied. So whether it's a mortgage or two mortgages or a tax lien or a mechanic's lien or whatever else might be attached to that property, that it's all accounted for, that it's all settled by the time that you purchase it, so that when you purchase the property, you are getting it free of any kind of encumbrances. There's no additional liens. And this title insurance protects you in case something gets missed, right? We're all human, so whoever's reviewing the title work at the title companies, certainly human. They could miss something. There could be a lien that doesn't get paid when you buy your house. This title insurance protects you from having to eventually pay that down the road when you go to sell again or you go to refinance. So it's sort of, it's just like any insurance, right? It's in case something happens, and this is in case the title company misses, whatever it is, any kind of lien or any kind of mortgage that would be on the property that you're purchasing.
Yeah, it definitely protects the borrower. I've known some people who have not gotten title insurance because I don't think you have to get it unless you.
Well, there's two kinds. There's two kinds of title insurance. There's a lender's title insurance, which lenders make you purchase to protect them from, again, these encumbrances that could be on the property. So they want to make sure that they are getting the title free and clear. So lender's title insurance is definitely something that you have to purchase. Then there's owner's title insurance, and that's optional.
Right.
That's what you're talking about. that protects you, the buyer, from these liens or mortgages that could be recorded on the property. So two kinds: lenders, you have to buy; owners, you don't have to buy, but you really should.
Yeah, you really should. Again,
totally.
We've heard nightmare stories. So the next thing are your inspections. Obviously, you have a home inspection that you can get done if you'd like. That's something you pay for when it happens, but there's other inspections that you have to pay for, and sometimes it depends on the loan type too, because different loan types require different inspections to be done. Either way, you get the inspection done, the inspector goes out, they inspect whatever they're inspecting, so it could be a well inspection, a radon inspection, a home inspection, whatever it is. And once it's complete, we get the information, we get the paperwork for it, but you are making the payment on it. So it is something that is included in your closing costs, but that is another thing that you're paying probably before settlement. So
yeah, definitely. Escrow account. So this is probably one of the more complicated things that we educate borrowers about, but an escrow account is essentially an account that's set up for another purpose. So, in most cases, it's homeowners insurance and property taxes that are collected when you go to closing. Say your property taxes are $200 a month. Each month, that's part of what your mortgage payment is. Part of your mortgage payment is property taxes and homeowners insurance. And so those monies are collected throughout the year, placed in this escrow account, and when those bills are due again, in general, most places in Maryland, property taxes are due 2 times a year. So when those property tax bills come due, there's enough money in the account. Same thing with the homeowners insurance that's paid annually. There's enough money in that account to pay at the end of the year. So at closing, we start an escrow account because we want to sort of build a little bit of a buffer in that escrow account for you, so that by the time you get to, making a payment after 10 or 11 months and the bills come due again, we want to make sure there's enough money in that account. So we're going to collect some months of property taxes and some months of homeowners insurance, and when you go to closing, and start that buffer that we're talking about, so that you don't fall short. Because when you fall short in your escrow account, then your servicer has to increase your mortgage payment so that you can cover that, or you've got to stroke a check for the difference. And you don't really want those things to happen if you don't have to. And so part of the closing cost up front is building this buffer so you don't fall short, or at least not too early on in your mortgage.
Right. Recording fees. So recording fees, it's basically a government fee to record the transfer of you purchasing the home. So there's a deed that's recorded. We have to prove that you own the home. So there's fees associated with the government doing that for you. It does vary by city and county. I know different cities and counties can be a pleasant experience to work with when they're recording your fees, or they can be not a very pleasant experience. It just kind of depends on where you're purchasing and who's handling that for you. But that is another fee that you're going to see in your closing costs, is to record the deed, to record you purchasing the home, transferring it to you. So when you see recording fees, that is what that means. Yeah.
Transfer taxes. All right, so transfer taxes are essentially the sales tax that the county and the state collect when you purchase a home. Every state's a little bit different. We're based in Maryland, so we can probably speak to Maryland a little bit better than some other states. So both the county, or Baltimore City, that you purchase in, as well as the state, charges documentary stamps and transfer taxes. And again, it's essentially the sales tax that's due for a real estate transaction. And generally in the state of Maryland, it's split 50-50. The buyer pays 50% of the total cost and the seller pays 50% of the total cost, but those sorts of things are negotiable. There's also a break for being a first-time buyer in the state of Maryland. The state's portion of the transfer taxes are waived, so it's a little bit cheaper to buy the first time around. After that, you do not get an exemption, even if it's been more than 3 years. Since you've owned a home, generally 3 years, you are considered a first-time home buyer. And that opens some doors to like down payment assistance programs that might not have been there before. But as far as the credit for being a first-time buyer in the state of Maryland, you only receive that one time, and that's the first time that you purchase a home in Maryland. Transfer taxes are usually the single largest line item on the closing disclosure or loan estimate that you look at. Just for instance, in Anne Arundel County, where we are based, the total between the state and the county documentary stamps and transfer taxes is 1.1% of the sales price. So on a $400,000 sales price, that's $4,400, and that's usually the largest line item you'll see on any closing disclosure. So it's really important to know what those are, but it's essentially just the sales tax for the transfer of property in the state.
Yeah, definitely look into your homestead credit if you've already purchased.
Yeah, for sure.
So HOAs and condos. So when you're purchasing an HOA or a condo, there's usually a fee associated with it, and it's put together by the association. So they assess the condo or the HOA itself, and then they put together this fee, and that's what you pay monthly. The costs are going to vary. It just depends on where you're purchasing, the location, and all that. And it's good to know that the future costs of those can change. So your HOA isn't just set at $50 a month included in your monthly payment. If they reassess your HOA, it could go up 50 more. Like I have an HOA where I live, and it goes up every year, right on time, and I noticed it kind of thing. But they're reassessing the HOA establishment that I live in, and they're coming out and letting us know that, hey, the fees went up. So that's something that I have to account for. So just know when you're purchasing and you're part of an HOA or a condo, those fees can change, and to look out for it, kind of thing. So anything that you want to add about
Yeah, well,
HOA?
specifically for closing costs too, there are fees that are associated with purchasing in, a condominium complex or an HOA. There's paperwork that we need filled out on our end of things. And a lot of times, we have to pay for whatever that is. So we have these, condo questionnaires or homeowners insurance questionnaires that the management company has to fill out. We pay for those. The buyer pays for it at closing, so it does add a little bit. It's not a lot. Usually it's a few $100s, but it is something to be aware of. It is like an additional cost that you would incur if you're buying in an HOA or a condo versus if you were buying a single family home that was not in a homeowners association. You would not have those fees.
Yeah, good point. Another thing to touch on is down payment assistance. So there are a lot of people, whether you're a first-time home buyer or not, who try to utilize the down payment assistance if they can. And these are programs that help with your closing costs. So the goal is to offset some of it, if not a good chunk of it if they can. In order to use some of these programs, there are fees associated with it. The first program that comes to mind is the Maryland Mortgage Program. I know that they do require, and it's not a big fee, it's a small fee, but if you want to use their program, they set you up to use it, but you do pay that small fee, which is included in the closing cost breakdown. But you're getting your down payment assistance, which is then a credit to your closing costs. So it kind of, outweighs itself. But that's something to note on. And if you're going through a program, you're going to see that as a part of your closing costs, and you can see it broken down kind of thing.
Yeah, and the amount that you get in down payment assistance far outweighs the amount that it costs to participate, so it's certainly worth looking into.
It's only a couple $100 if that put together, but then you're getting a couple $1,000s usually from these programs, so I would think that it would be good.
Yeah, definitely. All right, so we're going to move on to some common questions that we get, and I think the absolute most common question that we get about closing costs is, can I roll closing costs into my loan? The general answer is no, that's not something that you are allowed to do. There are some programs out there that may allow you to do something like that, but in general, if you're looking at, an FHA loan, a VA loan, a conventional loan, like these traditional financing vehicles, you cannot roll closing costs into your loan. Closing costs are due at closing. There are a few things you pay along the way that we mentioned, things like an appraisal or your various inspections. But the bulk of that money, the bulk of those closing costs outside of the appraisal and the inspections are going to be due at closing. So you can't roll them into the loan. You have to pay for them at closing. We'll transition into talking about who else can pay those closing costs for you. Next.
Yeah. So another question is, can I get the seller to pay some or all of my closing costs? If so, how much? So yes, seller help is a thing, and it is coming back in the market. I've gotten people who have gotten seller help.
Same here.
Yeah.
Same.
So that's a way to alleviate some of the closing costs that you do have. Each loan type, they have a maximum percentage that you're allowed to ask for in seller help. So that's something that we would help you understand and know. I think with FHA and USDA, the maximum is 6% seller help. With conventional, it's 3%, and then with VA, it's 4%. There are certain circumstances where the seller cannot pay the down payment. So borrowers have to come to the table with their full down payment. The seller help cannot go towards that, but it can help with closing costs. So the answer is yes, sellers can help. Yes, you can ask for it. Yes, they are giving it. Yeah.
And you're right. You do, as a borrower, as someone who's buying a house, you have to come to the table with what your down payment is.
Yes.
Whatever it's 3% on a conventional loan, or 5%, or 3.5% down with an FHA loan. So then the next logical question that comes up is, where can these closing costs come from? The obvious answer is it can come from your checking and savings, your own money, obviously, you can use to buy a house. Some of the other ways that I've seen borrowers obtain money to buy a house is through either a gift from a family member or a close friend. There's a couple of pieces of documentation that go along with that. You have to also document the transfer appropriately, but we're skilled at doing that and we know how to get it done. So we just walk you through it. It's pretty easy. Another way that I've seen people use finances that are sort of outside of traditional means are pulling from a retirement account. So if you have a 401k or a 403b or an IRA, and you want to pull from that to use for your down payment and closing costs, you can. Obviously, that could take a little bit longer to get because it's not liquid. It's not yours just yet. You have to apply for it. You have to get it. You have to show us that you have it. So it could take a little bit longer. But certainly, if you have a 30-day settlement or a 45-day settlement, you're going to be able to document that, and we can help you document that the right way.
Yeah. So kind of wrapping up with the closing costs talk here. In closing costs, Tim, what is tax deductible? And before I ask you, Tim, I would like to say that you should 100% be consulting your tax advisor before you do any of the stuff that we're going to mention or tips or anything like that. That is super important. But Tim, yes, in closing costs, what is considered tax deductible? Yeah,
so when you purchase a home, again, going back to the escrow account, you're going to pay some months of property taxes up front. And you're also paying interest from the day that you purchase the home through the end of that first month. So when you're looking at a closing disclosure, you have however many months of property taxes that you paid up front, plus the interest that you paid. Those things are tax deductible. You're going to get a 1098 from whoever your mortgage servicer is. They're going to let you know how much interest and property taxes you get to deduct. So not only just from closing, but also throughout the course of the year. The property taxes that you pay, the interest that you pay on your mortgage, those things are tax deductible. There are certain cases where things like mortgage insurance are sometimes tax deductible. So if you pay a monthly mortgage insurance and upfront mortgage insurance, from time to time, those things are tax deductible. The points that you pay to get a lower interest rate are sometimes tax deductible. But again, definitely want to consult somebody that is a little more well-versed and specifically, it does that sort of thing all the time. So if you have a tax consultant, that's absolutely something that I would ask them about.
Right.
For sure.
Yeah. Well, thanks for answering that, Tim.
Of course, yeah. All right, well, we are here to help. So if you have any other questions about closing costs, anything we didn't cover today that you think you might want to know the answers to, certainly let us know. But we're always here to help you and happy to do so.
Yeah, just let us know. Shoot us a question and we'll answer it for you. It might be the next podcast episode.
Oh, that'd be fun.
Yeah,
Q&A?
I know. That's what I'm
that'd be kind
saying.
of cool.
Yeah.
Okay. All right, well, we'll see you next time.
Anyways, have a good day.
All right, bye.
Bye.